Management rights is the business of providing caretaking and letting services within an accommodation complex. It's a growing and lucrative industry in Australia as it gives you the opportunity to purchase a home, a business and a solid investment all in the one package. Choosing the right investment type for you and your situation is the most important aspect of purchasing a management rights investment. Therefore, this DVD is divided into chapters to provide you with professional advice from each stage in the purchase of a management rights investment. PCS Finance has put this DVD together as part of their commitment to making management rights work for you. We will start by talking to David Ruxton from Dreamtime Resorts, who purchased his first management rights over 40 years ago.
Actually, I came into the management rights via default. Being a builder, I built some units in surface, and came down from Brisbane to live in 1966. What I found was that by giving it to the agent, nothing really happened. So the reason for coming down was to live on site so that we could do the letting ourselves. From there, as we built up, I discovered that you cannot have enough rooms, you haven't got the money to build enough rooms to enter properly into the tourist trade. So you really have to go into managements where you buy the management only and you've got access to a volume of rooms. Then you can do deals with the airlines and the other travel personnel that you have to, and to make the living that it is. It is a really good living, and it's a living that's an enjoyable one. I'm coming on for 74 now, and I've been in it since 66, and I'm not stopping.
There are many types of management right options available to you, such as permanent, holiday, corporate, and student complexes. One of the first questions you should ask yourself is, which one is right for me? David Ruxton from Dreamtime Resorts gives us his personal opinion between holiday and permanent lettings.
Well, the holiday lettings, in my opinion, are the better side of management rights. Rewards are better. The lifestyle's better, you meet the right sort of people, and if you're a people person, every day's a pleasure. The money is fairly good too, but if you're not a people person, don't go in it at all, or if you want a more laid-back style, maybe a permanent complex is a better one for you.
Karen Dosser from the Chancellor Apartments will answer a few questions on corporate lettings.
My name's Karen Dosser, and along with my hubby and our business partners, we have just bought a off-the-plan complex at Varsity Lakes called the Chancellor. It's being off the plan, there's quite a few challenges involved. It's actually 4 stages, 2 of which are called the Chancellor, and the other 2 stages are called Chancellor Lakeside. When it's all complete, which will be about October, November, possibly next year, we will have 170 one-bedroom corporate let units. We don't cater for the holiday market. We are short stay, we don't do leases. We are like a holiday stay complex, except that we predominantly cater for the corporate market. Okay, to be a good corporate complex manager, it takes a lot of skills in relation to people management, not just your staff but your actual guests as well. You've got, in a permanent complex, you've got your tenants and you've got your investors. Well, here we have got our guests, they're not tenants, they're guests. We have our investors, we have staff, we have contractors. It's a new building, so we've got tradies going in and out the whole time. We're trying to develop the next stage and the 2 more stages after that. So we're juggling a lot of balls in the air at once. We both, Ron and myself, come from a hospitality background, so we are used to dealing with lots of things happening at once, but it does take a lot of work. It does take a lot of organisation and a lot of understanding of your investors' needs. Many of our investors, this is the first time they've gone into a corporate-led environment, so they don't often understand what's involved, so I spend a lot of time. I always look after my investors. I spend a lot of time looking after them, making sure that they are happy with their investment, because if they don't, they're going to sell it, so it's in our best interests to do that. But your guests have got different needs as well. Some need to check out at 4 o'clock in the morning, some don't arrive till 1 o'clock in the morning, some of them leave things behind which you've got to get couriered off to them, some of them need such and such in their room on arrival, some of them need to have a slice of lasagna in the fridge on arrival, others need a bottle of red wine waiting for them, and it's a matter of juggling all of that. And if you can manage all of that, you'll get those people back all the time. But then there's also your rates vary from one night stays through to longer stays. You're dealing with lots of marketing issues about how do we actually go out and sell the rooms. So we're dealing with web-based wholesalers, we're dealing with regular wholesalers, we're dealing with credit accounts, corporate accounts that we have. There's lots and lots of areas that need to be dealt with on a daily basis. We're constantly working on everything the whole time. It's not the kind of business like a permanent complex where you just think, okay, the lawns have got to be mowed today and the rent's got to be collected, that's it. There's a lot more involved in it than that. But it's good, it's great. The advice I'd give somebody purchasing management rights for the first time into a corporate environment would be prepared to work hard. In the early days you'll need to do quite a few hours. Surround yourself with the right staff and the right contractors so that they can concentrate on what they do and you can concentrate on maximising your exposure to your preferred market that you need to go out and target.
Rex Fitzgerald from Varsity Towers will answer a few questions on student lettings.
Caroline and I have got the management rights here at Varsity Towers. We're also the licensees and the nominees for the bar inside, and we've been in business here for 2.5 years now. The most important advice I'd give to any purchaser purchasing student accommodation is to make sure they've got the right information. Seek out professionals and only use professionals that have great knowledge of the management rights industry. The most important skill is people management. Anything to do with management rights, it's all about the people. You've got the body corporate, you've got the owners, the guests, i.e. the residents and tenants there, and it's purely about balancing the wants and needs of each and every individual there and balancing it up so that they're all happy. The permanent residence is pretty much a set and forget. They're in for a minimum 6 months, quite often 12 months. It's much easier. The student accommodation one is go, go, go. Approximately every 15 weeks you turn them over in and out. The returns on a student accommodation are much greater than a permanent accommodation, very similar to similar if not the same as a holiday.
After you have decided what type of letting would suit you, it's time to find out how much you can borrow and what is the best option for you. Damien Windle from PCS Finance will guide us through the process of seeking finance.
It's important that the purchaser deals with an experienced finance broker or banker because there's so many different products and benefits out there to people when looking through all the lenders trying to work out which is the best product. At PCS, what our role is to go through all those options and help the client source the best deal. And that best deal could range from either a bank lending them more money than another lender, coming up with the cheapest product, placing fair conditions on their loan product, or it might mean the client needs to borrow more money in the future and that particular bank will support that transaction now. PCS has been involved in the industry now for 13 years. We've got a lot of contacts in the industry. And we actually specialise in providing finance to this industry. We don't try and wear too many hats where we say that we can do a lot of different types of finance. We concentrate on this specific industry. Because this industry is specialised, it can be very time consuming, confusing for clients, especially first time purchasers, trying to work out which is the best option for finance. There are a whole range of banks out there in the marketplace who are offering different products and benefits to clients, and for someone to try and spend a lot of time trying to work out which is the best deal. As I said, it can be very time consuming, confusing. At PCS, because we have the contacts and expertise, we help the client go through that process. We talk to the banks on their behalf, and we come to them with a few different options and, I suppose, weed out the better ones to the bad ones, rather than them spending the time actually doing that. People automatically think that the cheapest deal is the best option, but in some cases the cheapest bank may offer the poorest service, or their loan conditions might be quite inflexible, or they might reduce that person's borrowing capacity, which can have an effect on the business they actually purchase. So we try and educate clients to look at the overall finance package, not just what it's going to cost them. Your borrowing capacity can vary depending on the lender. Usually the banks will lend between about 65 to 75% of the combined market value of the business and the residence. It's also subject to the location, the price of the unit to the business, how long the agreements have got to run on that management rights business, and also depends on the affordability or the income from that specific business. The equity or capital requirement can change depending on the actual business, but usually again you can contribute between 25 to 35% of the market value. In addition to this, you'd also have to have approximately 5 to 6% of that purchase price to cover your costs, and the costs would be things like legal costs, accounting costs, borrowing costs, cost to do your licence, and the biggest cost of all is government stamp duty. Your cash or equity contribution could also come from equity in another property. So for example, some people may have other investment properties. They may want to gear up against those properties, so the bank can use that equity then to go towards the purchase of that management rights. When people are borrowing to contribute their equity, it's very important then we look at the affordability, because maybe the overall income then may not be able to service that debt, but the banks will consider that. The banks are very competitive to lend to this industry. One of the reasons why I see that is because they class it as a low to medium risk industry, and that's supported by the fact that these businesses have what they call a body corporate salary. The body corporate salary is almost a guaranteed income. So for example, if you were to lose all your units out of that letting pool, you would still have that guaranteed income of body corporate salary, which still adds value to the business. So the bank can see some comfort there, knowing that if that was to happen, they would still have a valuable asset on their book. In addition to that, the industry is quite regulated. All stakeholders are protected by legislation. The manager has to have a licence to run the business. There's also an account they have to run, which is a trust account. So there's legislation in place to control the operation of that account. So that reduces the whole risk of this management rights industry, and the banks are very competitive to get more of that lending. If you don't have the required equity to buy management rights, the other option is that we can help you form a partnership and introduce you to people who are silent investors and would have the required capital to buy that specific management rights.
Now that you know your finance options, we will find out how management rights is valued by Christopher Kennedy of CB Richard Ellis.
When we're valuing management rights, we're basically looking at two components. There's the real property, the freehold property, which generally includes a manager's residence and an office reception area. Can also include other things as well as linen rooms and conference rooms and day rooms and all those sort of things as well. But it's generally a residence with an office reception attached to it. We're then also looking at the valuation of the management rights business itself, which is based upon a report which is given to us, an accountant's report, to which we apply a multiplier factor to that to come up with a total value for the actual business. The asking price for each component would be calculated separately. In terms of the residence or the manager's unit, we're looking at what the residential value of that unit would be as if it was a residence. So we look at other sales of units within that particular building or that complex, or similar complexes around. And we judge a value for that property based upon it as a residential property. We then look at the added value of any other areas which are attached to that unit, whether it's an office, a reception, or a storage room, or a conference room. We look for the added value of that, and then to that value we then add a premium, which is a premium which is attached to all managers' units as a consequence of the fact that's the only unit from which the caretaking and then letting rights may be undertaken. So that's the process which we look at in very simple terms in relation to the valuation of the actual residence. Well, a multiplier is what we use in the valuation of the management rights business itself. It's actually an analysed figure. It's actually called a year's purchase factor, and basically what you're saying is I'm multiplying this business by a year's purchase factor of 5 times. So what you're saying is that the net income which has been assessed by the accountant multiplied by 5 times equals the price which the property is worth. And we actually are able to analyse year's purchase factors or multipliers from sales of other properties. We then compare those properties with the subject property, and then we apply a multiplier which we think is applicable to that particular property. And those multipliers can vary for many, many reasons, but that's what we're doing. We're actually applying a multiplier factor to that property, comparing it with other properties which have actually sold. The multipliers have remained very strong in the time that I've been involved in the management rights industry since the late 1990s. They've basically gone from about 3 to 3.5 times, and now the majority of properties are selling with a 5 in front of it. Some properties are even selling for multiplier factors slightly higher than that, but generally for a particular good reason. If there's potential to increase the income for that particular property, some people may adjudge there's the potential to buy that property at a slightly higher multiplier and still make a profit out of that. But generally we now have settled into a situation where the majority of properties will sell with a 5 in front of it in terms of the multiplier. In relation to the financial figures which the financiers are looking for, they are actually looking for, in the majority of cases, audited or the figures which have been undertaken by an independent accountant, which has calculated the net income for a particular building or complex for the last 12 months. Now, they look for that last 12 months because that gives a very good indication of where the business is at this particular time. You know, some people think that maybe you need 3 years or 5 years figures. That may be the case, but in reality we're looking at the last 12 months, we're looking at how those people have managed that business and how that business has performed over the last 12 months as an indicator as to how it will go for the next 12 months, 2 years. So they're looking basically for today's value based upon today's income. Now, different management agreements can affect the value of the management rights business. Since the introduction of the legislation in the late 1990s, we have now 3 or 4 different modules in which a building can be placed. The accommodation module is the most advantageous. That's the one that allows you for a maximum term of 25 years. I have a particular saying which says certainty equals value. The longer the term of your agreement, the more certain you are to retain that business, and the more you'll actually pay for that business. We also have a standard module within that legislation as well, which only allows for a maximum of 10 years for the agreement. Now, the majority of financiers are looking for continuation of an agreement for a minimum of 7 or 8 years. So you've got the situation where if you've only got a 10-year agreement, then you're looking to continually top up that agreement to make sure that your financier is happy and you have that certainty. So under my rule, certainty equals value. Those longer agreements under the accommodation module for 25 years are advantageous when compared to the shorter agreements or 10 years under the standard module. The multiplier which is applied to the net income can be affected by the type of property which you're looking at. Obviously properties which are high volume income properties located right on the beachfront, they're very sought after properties, so people will pay higher multipliers for those properties, as opposed to perhaps a holiday complex which is in a secondary location. Very hard to get people to go to those properties, the income is lower, they are not as attractive. The other type of property which we find which is very attractive are your larger permanent complexes which have really nice units, nice townhouse or villa units, lovely landscaping, plenty of facilities. They're very sought after as well, and oftentimes I find people will come out of holiday accommodation into those types of complexes looking for that additional income. They're very, very sought after. You also have other properties within that class of permanent accommodation which are not so sought after, where in the same case with the holiday properties, where it's harder to get people to come to those complexes and live. Your tenant profile is not as good for some properties as opposed to the better properties. So yes, generally the location of the property and the type of the property can actually affect the multiplier with which we apply. Also the level of income which you're receiving. The higher the level of income, we find the higher people will pay in terms of a multiplier. We are finding in the industry today that if you have a situation where the value of the unit is high when compared to the net income, there is a little bit of market resistance in relation to those properties. People don't like to spend a huge amount of money on the unit, they want to spend their money on the business, because that's where they're getting their tax advantage from, the business, not the residential unit. So if you have a situation where your unit's worth $1 million and your business is only worth $500,000, it makes it a little less attractive to the wider market. Doesn't say that you can't sell that, but it just makes it a little less attractive. So the multiplier will naturally be slightly lower in those cases. So where the property is, the type of the property that it is, and the level of the net income can actually affect the multiplier which is applied to the property.
The role of the manager is a very important aspect of running a successful management rights, and Wesley Venz from Venz Management will answer a few key questions.
My name's Wesley Venz and I work as a business broker in the management rights industry and also as a lecturer for the Resident Letting Agents Licence course. People who enter the management rights industry for the first time come from all walks of life. I've personally dealt with police officers, farmers, builders, just about every walk of life. The main experience they need is people skills and the ability to do basic bookkeeping and computer work. So it really is something for everyone. Yes, the minimum requirement to run a management right letting business is called a Resident Letting Agents Licence. And to obtain that qualification you need to do 6 modules at a recognised training organisation such as the REIQ or the TAFE. This course can be done by classroom delivery, which takes 5 to 8 days, or by correspondence. Then you can apply to the Office of Fair Trading to obtain your licence. Yes, a manager can live off the site, but it depends on 3 things: on the entity you buy the business in, on the licence that you have, and also what the agreement with the building states. However, there's many managers out there that own more than one complex, so normally they would have a registered employee who lives on site on their behalf. So anything is possible. Yes, there's several different licences. Under the Queensland legislation, you need a Resident Letting Agents Licence, or RLA, to run a management rights complex. In New South Wales, it's called an on-site property manager's licence, so there's different legislations for each state. The other states don't really have legislation that covers management rights specifically, but you can get a full agent's licence to manage a management rights type of complex. Also in Queensland, if you want to get into different aspects of real estate, as in selling of units, you can go for a salesperson's licence or a full real estate agent's licence. And then you can not only let lots in your complex but also sell lots in your complex.
making sure you have the right legal advice and understanding your legal obligations will be presented by John Marnie of Marnie Lawyers.
Management rights is a name we give to the on-site manager who lives and works in accommodation complexes, these large strata-titled accommodation complexes you see. The manager, on-site manager there, looks after the caretaking or management role and looks after the letting of units for owners who want to use the services. There's a range of different type of accommodation that's provided. It's short-term, permanent or holiday, corporate lettings and perhaps student lettings as well. Well, caretaking letting agreements are what really make management rights possible. They're the agreements between the on-site manager and the body corporate. When I say body corporate, I mean the owners acting together as one body. They are called the body corporate. And the agreement will provide for the manager to be paid a remuneration by the body corporate for carrying out the caretaking duties, and then the letting agreement will allow the manager to operate a letting business. Now, the agreements are a very important part, obviously, of the whole management rights concept, and they get called different names. They might be called a management agreement or a caretaking agreement, letting agreement, and there's one we had called the village coordinator agreement of all things. The manager will generally buy a unit in the complex as well, and that's one of the requirements, is that the manager has to live on site, either the manager or representatives. So they'll buy a unit, and in addition to the unit there'll be an office. Now, the office might be part of or attached to the unit, or it might be a separate component within the building that the manager either owns or has a right to occupy. The duties are spelled out in the agreements. From the caretaking point of view, the manager will be required to look after the common areas, the cleaning, the grounds maintenance, lawn mowing, pool cleaning, those sorts of things, and also supervise the contractors of the body corporate engaged in work that the manager doesn't have to carry out, like repairs for skilled tradespeople, for example. And also the manager, under the letting component of the agreement, will be required to offer a letting service for those owners who want to use the manager's services. Now, the agreements themselves can be quite complicated, and it's very important that you have someone who knows what they're doing from a legal point of view look through the agreements for you. The other income comes from the letting side of the business, and the manager is what we call in Queensland a resident letting agent, and that gives them the right to offer lettings for unit owners who want to use their services. So from that point of view, you make money from your commissions and your management fees you charge to the owners. You also provide other services to the owners, such as linens and cleans in the holiday complexes, perhaps PABX rentals and pay television as well. And then you provide services to the guests as well, such as tours, and you make money from that as well. Apart from the agreements, there are bylaws that are a very important part of the whole management rights concept as well. And it is quite a difficult and technical area, so it is very important to have someone who knows what they're doing go through it for you.
PCS Finance are in the business of making management rights work for you. In this section, Steve Burton, the founder of PCS Finance, will talk about how the management rights industry has shifted over the years and how it is possible for mum and dad investors to get into larger management rights through partnerships. Finally, there are testimonials from people that have benefited from these partnerships.
Well, I used to work for the National Bank, and I was involved in management rights lending for that bank for many years. About 15 years ago, I went into my own business, and people came to me for help who were buying management rights, but they couldn't borrow enough money from the bank, or the bank wouldn't support them. So I got a couple of other lenders involved, and we managed to get those guys into management rights. So I thought I'd hang up the PCS Finance shingle and make it a full-time business. Back in those days, there was only one major bank lending on the Gold Coast. We got a couple of new lenders involved. The bank was charging 4.5% margin above their base lending rate, so they were lending a lot higher interest at a lot higher interest rates than to other businesses. So we came in at least 3% less with the newer lenders. So what it forced was the banks to put their rates down to meet the market, and everyone benefited from that at the time, not just my clients. Because the bank knew they were going to lose their clients fairly quickly if they didn't start matching the business. So we got more lenders involved over the years, Now there's at least 8 or 9 banks with good policies on management rights. We help develop the lending products, so the banks now use products that suit mum and dad managers and suit the industry. So it's really made it a lot more professional the way the finance happens on the, in Queensland and the rest of Australia for management rights lending. Well, we can offer you the best finance deal because we work with all the banks. We won't muck you around. If we can't do it, we'll say so. If one bank, we decide to go with one bank and for some reason that gets too hard, we can quickly switch it to another bank. We help you handle the process. We help you with the licensing, all that. All the partners of PCS and the staff, except for reception staff, have been involved in managing and owning management rights, so we're all heavily involved in the industry. The industry works best with mum and dad managers running them. A mum and dad has their own money invested in the business, they look after the unit owners, they work hard, and the building runs well because the unit owners have to be looked after. They're the clients for the managers. The public companies just put a salaried manager on and they strip as much income as they can out of the buildings. So there's been a lot of bad press with the public company involvement and a lot of unhappy unit owners. Well, we started putting partnership arrangements together where a mum and dad manager didn't need the full cost of the management rights. With a combination of bank finance and private investor finance, we'd accumulate enough money for them to be able to get into the bigger management rights. They get in there and they still run it as their own business. They live on site and they work it as their business. But they can get into a much bigger building with the partnership arrangements.
PCS were instrumental in the purchase of Varsity Towers. Unfortunately, we didn't have the money to buy it outright ourselves, so PCS helped us form a syndicate and get together a partnership. That partnership has gone on to greater things and has since purchased a second building in Brisbane, and we're currently looking with a partnership to buy our third building. So the partnership is great.
PCS assisted us over the years simply because in the first place there was only a couple of banks that actually gave money to management rights. They weren't a really recognised industry. It was obvious too that PCS were professionals in what they were doing and understood finance far better than I did, and they were able to put the deals together with the bank for me at a rate often cheaper than we could get if we walked straight into the bank ourselves. They understand the industry. If there's a special going, they know which institution is putting the special out, and having got everything through for you, you realise it's a pleasure to work with them because they've taken a lot of the work out of the final part of the contract before you've gone in.
Well, in the very early days, before we even got into management rights, we started doing some investigation on how we could afford to buy into it. It seemed such a huge amount of money, and why was so much money involved to buy a business that seemed fairly simple at the time. And so we went to a conference where Steve Burton was talking, and he gave me enough information on that day to come away and think about it. The next day I phoned him back and challenged him over some of his theories, and he referred me on to Damien Windle. At the time we were really busy, and Damien arranged to come out and meet us at our house at a time that suited us, and he came with lots of scenarios and lots of information which he explained very carefully to us, took a lot of the mystery out of it for us so that we understood the actual culture behind what management rights was all about, made us very enthusiastic. He referred us on to other managers to chat to them who had used PCS and had been in the industry both for a while and were new. He referred us on to people that we needed to have insurance through. He referred us on to various banks, but he did all the work basically. Damien did all the work, and I used to email him on a regular basis and say, okay, what if we this and what if we that? I've seen this property, it's this, the unit's worth this, what are these scenarios? And he used to email me back on a very regular basis, and gradually we worked our way down to a number of properties we decided to go and have a look at, and fell in love with the one we bought, and it was the best thing we ever did. Thanks to Damien, or thanks to PCS, we would never have been able to have done that without their help. They took all the mystery out of it, provided us with the information we needed, and gave us projections that were realistic, and so we knew where we stood.